Namaste and welcome to this video on the mechanics of the indirect method of presenting cash flows as per Accounting Standard 3 and also IND AS 7. So this video basically explains the logic of the indirect method, why we do certain adjustments and how is it that it helps us to present the cash flows, right? So let's take the example of sundry debtors account. So we have balance brought down, we have sales, credit sales, then we have say bad debts written off, we have cash received, and then we have closing balance. So under the direct method, what do? We just present this 9,50,000 as it is. So if you were to open cash account, what would be there in the cash account? On the debit side, you will have this 9,50,000 as two sundry debtors, right? So whatever appears in the cash account will appear as it is in the cash flow statement in direct method. So as we all know, there are three different types of cash flows. That is, we have operating, investing and financing. Operating is principal revenue producing activities. Investing is relating to resources that will give us income in future, like PPE that gives us income in future. We use the PPE to produce our goods, let's say, and we sell, or we get dividend from our investments in shares. So those are all investing. And we have financing. So financing is cash flows relating to providers of capital. So we have three different types of cash flows in the cash flow statement. So whichever type it relates to, you just put it there. So this relates to operating. So obviously this company has sold its goods to these customers and it has received. So this is principal revenue producing activities. You just show it as it is. So under cash flow from operating activities, we will just show this cash received from debtors, right? That is direct method. Now, under indirect method, what we want to do is, instead of showing 9,50,000, we will be showing the other items plus opening balance 2 lakhs plus sales 12 lakhs minus bad debts 50 minus 4 lakh closing balance. The idea is we want plus 9,50,000 in the cash flow statement. So how do we get plus 9,50,000? 2 plus 12 minus 50,000 minus 4 lakhs. So if you do 4 lakhs plus 50 minus 12 minus 2, you are not going to get plus 9,50,000. You are going to get minus. So opening balance of debtor will be added, closing balance of debtor will be subtracted, sales is added, and then bad debts is subtracted. So this is what we do in the cash flow statement. Sales added, bad debt subtracted, opening debtor added, closing debtor subtracted. So if we do this in the cash flow statement, indirectly we get 9,50,000, right? Now of course, we are not actually going to write sales and bad debts as line items in the cash flow statement. They are included in the figure of profit, right? It is already there in that figure of profit. So by taking profit, by writing profit, you have already included sales and bad debts, okay? So do you want to remove bad debts because it's a non-cash expense? No, we are not going to remove bad debts because it's a non-cash expense. That's not the way to understand cash flow statements. The point is, we are writing 9,50,000 indirectly, and in order to do that, we need to write all the other items in some place in the cash flow statement. So balances are written separately and the incomes and expenses are included in this figure of profit. So in order to get 9,50,000, we need to include sales and bad debts, the related income or expense in profit, and we need to make what we refer to as working capital adjustments. So this increase in debtor of 2 lakhs will be shown as a positive value or negative value in cash flow statement. So you see here plus debtor, opening debtor 2 lakh minus closing 4 lakh. So this increase in debtor is shown as a negative value, isn't it? Going back to what we just discussed, how do we show 9 lakh 50 indirectly? By writing plus 2 lakh plus 12 lakh minus 50 minus 4 lakh. So plus 2 minus 4 is minus 2. Increase in debtor is to be subtracted. So it is not correct to say that increase in current assets represent outflow, therefore it is to be subtracted. No, it does not represent an outflow. It is written that way so that we get this 9,50,000 indirectly, right? So that we get this here. Effectively we need this plus 9,50,000. So if you want plus 9,50,000, you have to minus the increase. Only then it will tally, right? So we have understood two logical concepts. Just because an expense is a non-cash expense, you don't blindly add it. You need to check which ledger account it relates to and whether the cash flows in that ledger account are shown directly or indirectly. So bad debts relate to the ledger sundry debtor and the cash flows in sundry debtor are shown indirectly, in which case you should not remove bad debts, because only by writing bad debts you are reflecting 9,50,000 indirectly, right? So don't just remove an expense because it is a non-cash expense. You need to check which account it relates to. Second point, increase in debtors is to be subtracted. So conversely you can say decrease in debtors will be added, and then again increase in creditors added, decrease in creditors subtracted, right? So logically 2 points are clear now. Now the problem is this profit is not going to include only sales 12 lakh and bad debts 50, only the items that relate to our debtor account. There are going to be other expenses and incomes also, isn't it? So let's just go into that figure of profit. Let's drill down. So let's say this is what the P&L looks like. There is this sales, that is this credit sales, and then there is bad debts. There are obviously other expenses, other debits. So just since this video is just for understanding, so let's say there is an item of expense, that is depreciation, 3 lakhs. Now which account this depreciation relates to is what we need to see. So the sales and bad debts relate to sundry debtors, we want it there. Depreciation, do we want depreciation also in the value of profit in order to get some cash flow indirectly? That is a question. So this depreciation relates to which account? Depreciation relates to property, plant and equipment. Now let's say in this property, plant and equipment account we have opening balance 10 lakhs, purchase 5 lakhs and then closing balance 12 lakhs. Cash flows relating to property, plant, equipment, which is a resource used to generate future income or cash flows, should be shown where? Under investing activities. Now in cash flow statement, whether you follow direct method or indirect method, the cash flows from investing activities and financing activities are always shown directly. So that is because the reason the format has been framed that way by the framers of the accounting standard or Ind AS, that these are all material items. What is the basic principle of materiality? It has to be disclosed separately. You can't group them together. So we are not really bothered about the various items of our day-to-day running, right? So how much is what is the extent of cash flows our business is generating? That's what we need to know. We would also like to know how much equipment we have purchased, how much we have sold, have we raised any capital, have we paid any dividend, have we received any redemption. So these are all significant items. That's why both in AS3 and in AS7, cash flows from investing and financing activities are always shown directly. We don't group them together. So mathematically speaking, we can just take profit, okay, the final profit, balance sheet closing minus opening, and then make certain adjustments. Don't group them into operating, investing or financing. Adjust just the balances of all, and then you will get the cash flow, right? It will tally. That doesn't serve the purpose of cash flow statement, right? So the purpose of cash flow statement is to understand what cash flows our business is generating, our capital expenditure items, what are they, and financing items. The user would like to know all this. That is why investing and financing are shown separately. So this purchase of PP of 5 lakhs is shown directly as a negative value in the cash flow statement. So obviously if you open cash account, you will have on the credit side by PP. So cash received will be on the debit side, inflow, positive value we have shown already indirectly. So this cash outflow we are showing as negative value. Now, if you had done, instead of showing this 5 lakh as negative value here, hypothetically speaking, if you wanted to show it indirectly, what you would have done? This depreciation is already there here, correct? All you needed to do was to adjust this balance. This increase in PP of 2 lakhs, if you write it as a negative value here, okay, minus 3 lakhs is already there here, minus 2 lakhs, then it will tally. But we are not going to do that. We just discussed why, right? Cash flows relating to investing and financing are always shown directly. So when you have already shown this 5 lakh directly, do you need to show this change in balance and depreciation? No, then it would be double accounting, right? So do we want this depreciation here? It is already there. Do we want it? We don't want it. That is why we make a P&L adjustment to this profit. We add back depreciation. Okay. So if you just memorize non-cash expenses should be added, then bad debts is a non-cash expense. Will you add that also? No. So the logical way to understand the adjustments in cash flow statement is, first check which ledger account that expense or income relates to, right? The cash flows in that ledger account, are they going to be shown directly or indirectly? They are going to be shown directly, you need to remove them. If they are going to be shown indirectly, we need them. That's why we don't make an adjustment, right? So we have discussed 3 logical points. Why we don't adjust some non-cash expenses, why we show increase in debtors and other current assets as negative value, and the same is true for the other categories, decrease in debtors, increase in creditors, decrease in creditors. So that logic we have seen, and also why we adjust certain expenses or incomes, because those cash flows we are showing directly, right? So I hope this will make this video will make your learning of cash flow statements more enjoyable, and you are very clear about the logic, especially of the indirect method. So if you understand this simple logic, it is very easy to master cash flow statements. Enjoy learning till we meet again.